I think we've also got to remember that the Chinese reopening is very much a gradual process. You know, if we go back in sort of a time warp and remember all the gradual sort of reopenings, exit plans, all that kind of language is going to come to the Chinese reopening. They're not going to sort of turn around and sort of say, well, we're scrapping all restrictions. It's going to take them months to do vaccinations, to actually, undertake full relaxation. We're not talking about mask bans being removed in China, for example. So, and then the other thing is the Chinese population has been taught that COVID's really scary. Yeah. So then they're not, the voluntary distancing is going to be something that's probably going to linger in the first half of next year. So our growth forecast for China is better next year, but we think a lot of it really comes in the second half.
What is your growth forecast?
It's 4.7%.
That is a top-end forecast, isn't it?
But a lot of that comes in the second half of the year, not the first half of the year, because you get a gradual process. And for the global economy, that means that China is helpful, but it's not a game changer.
Right.
Mike, can I ask you about short-term positioning? Because it feels as though we've seen a lot of funds reallocate to more exciting parts of the world in recent weeks. I mean, I mentioned this reopening theme and how investors have gotten back on board from sort of no allocation to some of these markets. And even here in Europe, it's very rare that we see Europe outperform the United States. But it feels as though we're now going back into that mood music where it's all about the US market. Save it as houses, just play US markets. Even if it's going to be bad, it's going to be worse elsewhere than the United States. What do you make of that mentality now going into next year?
So I think that most of the major equity markets outside of the US were actually undervalued. If you look at the 12-month forward price earnings ratio, the US wasn't. And so people thought, well, this is a kind of an attractive entry point for an eventual recovery. Because we're already sort of entering a recession in Europe, we're already in recession in the UK. So, normally the time to buy is in the first half of a recession. I think that's a little bit premature. I think you'll still get Europe and the UK dragged down by the US. We're looking for 3,500 on the S&P 500 as the market discounts a mild recession in the US. The place to be is Asia, I think, because at least the Chinese reopening trade supports growth in Asia, and valuations are actually much better. And, policy is not really being tightened dramatically in Asia.
It's a done deal, is it, recession in the US? I mean, I know we've got this inversion on the 2s to 10s now, and that is a great signal for recession, and it seems to have been relatively reliable over the last 50 years, but it hasn't called them all. So is it a definite that we're going into recession?
We think it's a definite that you'll get a technical sort of recession, sort of 2 quarters of negative growth. I think if you also look at the broader tightening of financial conditions. We've got financial conditions indexes which pick up the feed through the Fed funds increases right across the market. And that has definitely sort of tightened. You're already seeing the effects in the housing market. We think that you'll see the effects in terms of slower business investment. And we think that additionally, as employment growth slows, you will sort of see consumer spending grinding to a halt. It's a pretty mild recession that we're talking about. So by this time next year, we'll be talking about economic recovery, but the market's not there yet in terms of discounting it. And that's why I think the story for the first half of next year is to discount that in the US equity market, and that drags down global markets.